Good afternoon, everyone, and welcome to our latest installment of the Stowe Degon webinar series. Today, we're going to be talking about Nexus, the changing face of Nexus, and we're fortunate to have with us one of our colleagues from Stowe Degon, who is probably the foremost authority in New England about state and local taxes, also known as SALT. Her name is Inez Mello, and she'll be joining us and talking in a couple of minutes. We're going to talk about just some an attendance guide. Okay, so this slide will just say three things. We welcome your questions. Look for the Q&A box and type any question you'd like Inez to answer in that box. We won't have time to take live questions, but put them in the Q&A. We'll do everything we can to answer all of those today. And if we know who sent the question and we don't get to it today, we will respond to you after the webinar is over. Second thing, the webinar is recorded. So if you are so inclined and want to watch it again, it will be on our YouTube channel. Or if you want to share it with other people in your organization or other friends. And third, there'll be a short survey after the webinar. We just want to know how we're doing. And we'll also ask you for other topics that you'd like us to have future webinars about. Okay. Disclaimer. It's February 3rd, 2022. And the information that Inez is going to go over today is the best information we have for state and local tax information and Nexus. And she's going to talk a lot about Public Law 8627, which is sort of the Bible that everybody follows. It's changing dramatically, and Inez will talk about that, but it changes month by month. So it's February 3rd. This is what's going on today. And if you have questions, please contact our office. Please contact Inez directly or your contact at Stowe Degon. So for the next 35 minutes, Inez is going to talk about three main topics. The first one is SALT and the kind of the theory behind it and some history about it. Second, she's going to talk about that term Nexus, which you may have heard of and you've never understood what it is. And she's going to talk about this Public Law 86-272. And third, she's going to get into economic and factor presence standards. These are things that different states use to determine whether or not your company has Nexus in a state. So it's my pleasure to introduce our colleague, Inez Mello. Take it away, Inez.
All righty. Thank you, Marty. I appreciate the introduction. First of all, good afternoon, and I want to thank you for joining me today. I know how busy everybody is, especially at the beginning of tax season. What I'm going to do right now is, to me, it's relevant, and I always do this beginning of my classes and the beginning of those seminars that I teach. I'm going to give you an overview, multi-state tax theory. What is the history of the theory? And what is the definition of the various pieces that make up that history? Because by the time we get to Wayfair, I want you to understand the relevance of Wayfair. When I say to you, the United States Supreme Court killed one of our sales tax court cases, Quill, I want you to understand the shock and awe of that, literally. So let's get going. If you can picture me the first night of class going up to the blackboard and drawing a large T account. And on the left-hand side of the T account, I call it corporate tax. And on the right-hand side of the T account, I call it sales and use tax. So under the corporate tax piece, we utilize what's called Public Law 86-272 to protect the taxpayer from having a corporate state tax filing requirement. I'm going to verbally tell you what Public Law 86-272 is, and then I'm going to pull it apart for you. And if you could see me, picture me now, visualize me on, writing on the chalkboard, actually drawing a large umbrella, okay? Everything under that umbrella is protected, but I'm going to tell you what to put outside of the umbrella. Public Law 86-272 states this. If you have sales of tangible personal property into what's considered a true net income tax-based state, and you can actually have a resident sales rep living in that state, but they are there only for the solicitation of sales of tangible personal property. So pulling it apart, Sales of tangible personal property. In this country, and I say that with respect, in this country, the sale of an intangible is considered not the sale of personal property. Again, I have a lot of clients along the Route 128 arc. So having a sale, a software license agreement is considered an intangible product. Just having sales into these states of a software license agreement, you would be afforded no protection under Public Law 86-272, and you would have created a state tax, a corporate state tax filing requirement. So sales of tangible personal property into a true net income tax-based state, all that means is that state truly, if you were to look at the first or second line on the return, it would say, and I pulled one up for you so that I can actually read you the verbiage. It says, enter the taxable income as it appears on what? On line 28 of your federal form 1120. And this was for a C Corp. So obviously, whatever your bottom number is, your net income number, is usually the first line on a true net income tax-based state. So sales of tangible personal property into a true net income tax-based state, you would not have that state's corporate state tax filing requirement. You could actually have a resident sales rep live in that state, and as long as they were there to do sales of tangible personal property. With that being said, for multi-state tax purposes, any state that's not a true net income tax-based state, we lump into a non-net income tax-based state. And everything that I'm verbally telling you now is clearly in your presentation. So again, for multi-state tax purposes, the theory is anything that is not considered a true net income tax-based state is called a non-net income tax-based state, like a franchise tax, a gross receipts tax, a net worth tax. Again, having sales into those non-net income tax-based states would create a corporate state tax filing requirement. Now, there have been some new Nexus standards that came along in 2010. And again, we're still under the corporate side. In 2010, California went to what is called a factor-based Nexus state. Back then, California said this. Now, California still follows Public Law 86-272. But back then in 2010, California said this. If you have sales of $503,500 into my state, tangible personal property of $53,500, or payroll of $53,500, or if 25% of your sales are literally in the state of California. It's true, we still follow Public Law 86-272, but you would now owe us the minimum tax of $800. Now, back then when that happened, just to put some relevance to this, I had a knife manufacturer, and the only sales he had into the state of California was the sales of knife, professional cutlery. So you can't get much more widgety than that. He had no sales reps in the state, nothing, just the sales. And he absolutely didn't have to file anything, not a return, an information return or a corporate return to California. I can tell you when this came out, it created a lot of confusion. And I was fortunate enough to be guest speaking that summer in Arizona. And on the panel with me was the representative, the head of the franchise tax board. And his name at that time was Charlie. And I said, Charlie, this is so confusing that I've been asked to do a presentation on it when I get back to Massachusetts. I said, you absolutely follow 86-272. How can you expect a return from us? And he said, Inez, listen, he said, describe it this way when you get back. He said, it's true. We still follow Public Law 86-272. Now, remember that umbrella that I told you that I always draw. He said to me, California has a minimum tax of $800. He said to me, a minimum tax is not a true net income tax. And so now where we couldn't get anything from you at all, he said, now you would owe that $800 minimum tax. And he said, that might not seem like a lot of money for you, Inez, or to you, Inez. He said, but I can guarantee you that it's generating hundreds of millions of dollars. Just by now, you need to pay that $800 minimum tax. So a minimum tax, again, is not a true net income tax-based tax. And so you're provided no protection under 86-272. Lisa, I don't know if you, oh, that's okay. You can keep it there. I apologize. Can you go back one, Lisa? I apologize. At the same time, in 2010, Connecticut went to what's called an economic-based nexus standard, the same summer of 2010. And again, I was fortunate enough to be guest speaking for Women Education Services in Hartford, Connecticut. And in the audience, there was 3 gentlemen, and they represented one of the largest newspapers in Hartford. And they came up to me and they said, Inez, we'd like to take you to lunch because we have a situation that we think we need your help with. So obviously I went to lunch with them and they're telling me this story. And they said to me, it's not about us, Inez. He said, for lack of a better way of explaining it, we utilize a Massachusetts, I'm going to call them printer/formatter. He said, and their niche is only newspapers. They only do newspapers. He said, and they're concerned about California now being an economic-based nexus standard state. I thought he was going to say to me, they format our newspaper, they print it, and then they deliver it in company-owned vehicles. That I would have understood. But this is the actual story as to what was going on. He said, you can actually visualize it. He said, it's sometime in the evening editors have to put the story to bed. He said, we then electronically send it to this Massachusetts printer. He said, the stories, the obituaries, the ad. He said, the Massachusetts printer then takes the newspaper and puts it in the format that we like. And they electronically send it back. He said, our evening editors then review it. And if it's okay, they sign off on it. He said, and we print it here for early morning delivery. Connecticut went to economic-based nexus standards that summer, and they had already started sending out notices. And this Massachusetts printer received a notice, even though they never stepped foot into the state of Connecticut. Connecticut went to an economic-based nexus standard. And the multi-state tax theory behind this is this. You are purposefully directing business towards my state, regardless of whether you have a physical presence or not. I'm going to say it again, and I'm going to say it about 3 times there in this presentation. And if you saw me teaching in front of the classroom, you would see me with my colored chalk, which I love to use. I would put that comma in big red. You are purposefully directing business towards my state, comma, regardless of whether you have a physical presence or not. They were successful in going after that Massachusetts printer format for a corporate state tax filing requirement. The only good thing about it is obviously they couldn't go back. You know what I mean to say? It was only a prospective filing forward. That's economic-based nexus standards, okay? Going now, Lisa, I don't know if you want to advance it. Thank you. Keep all this in mind. Keep Public Law 86-272. I'm gonna repeat that 3 or 4 times. You're gonna get sick of hearing me telling you what it is. Keep economic-based nexus, the verbiage to that in mind as we continue. Sales tax now is sitting over here on this side of my blackboard, okay? In 1967 and in 1992, we had 2 similar sales tax court cases that we utilized to protect a taxpayer from having a sales tax registration collection obligation. Both of them, it was National Bellicese versus the state of Illinois. And in 1992, it was the Quill Corp case and it versus the state of North Dakota. Similar fact patterns. Both were catalog companies sending their catalogs into the state and obviously generating substantial revenue through those catalogs. Well, in 1967, the state of Illinois came to National Bellicese and they said, wait a minute, you're just what? Generating too much revenue in my state. Clearly, you should be registered and collecting sales tax. And it went all the way up to the United States Supreme Court. And the court came back and said, no, that's not enough of a physical presence to require that registration and collection. Well, in 1992, the Quill Corp case came along. In the Quill Corp case, similar fact pattern. The major difference between the two, Quill was Quill versus the state of North Dakota. The major difference between the two is that when you received Quill's catalog and you opened it up, they had stuck a sleeve. And in that sleeve, they stuck 3 floppy disks. Well, North Dakota really went nuts and said, hey, wait a minute, listen, you guys, you're generating all this revenue and now you've got tangible personal property in the form of those disks coming into my state. Clearly, you should be registered and collecting sales tax. And again, that went all the way up to the United States Supreme Court. And the court came back and said, no, that's still not enough of a physical presence to deem that registration and collection process. But the relevance of the Quill Corp case in multi-state taxes is because of those 3 floppy disks. For the first time in multi-state tax theory, it gave us that notion of a de minimis present, that what we call a bright line white test. That's the relevance of Quill. To give you a smaller example of it, because you've got to understand Quill to understand the ramifications of Wayfair. I'm sitting here in Massachusetts right now. Years ago, it was actually Land's End, entered into agreement with Sears and Roebuck's at the Emerald Square here at Massachusetts. Okay, you could go into Sears and Roebuck's, you could look at the corner of the store, and it looked like Land's End. Okay. Prior to that affiliation, Land's End did not have a presence here in Massachusetts. So if you were purchasing something and you were a Massachusetts resident and you were purchasing something from Land's End, prior to that agreement with Land's End, you would not have seen, did you ever wonder why, if you were ordering online or through the catalog, why down below on the order form it said, if you live in the following states, please remit that state's sales tax. Well, prior to that agreement with Land's End, if you were a Massachusetts resident and you were buying from Land's End over the internet or through the catalog, you would not have seen, they would not have requested that sales tax. Now, after the agreement with Land's End, you would. That's the Quill Corp case that's protecting a taxpayer, or what I should say was in the past tense, was protecting the taxpayer from having to submit sales tax if they were purchasing over the internet or through, a normal order form. It was the Quill Corp case that was protecting that taxpayer from having that sales tax obligation. It was because Quill did not have, Quill gave us the presence or the essence of you have to have a physical presence in the state, okay? Coming along to 2018. Now, every time I taught my seminars, I always left the audience with this. I always would say to them, something wicked this way comes. Well, something wicked this way came on June of 2018, the Wayfair court case, okay? And it's Wayfair versus the state of South Dakota. Wayfair came out, and the United States Supreme Court, it was Justice Roberts that liked it. The United States Supreme Court looked at Wayfair, and they liked the fact that there was a de minimis amount of sales. Wayfair says this: if you have $100,000 of sales into my state, or 100 transactions or $200,000 of sales into my state or 200 transactions, you now would have a sales tax and some variation of that, which we'll go over at the end of the presentation. You now have a sales tax registration collection obligation, comma, without having a physical presence. Wayfair literally killed Quill. Wayfair is based on economic-based nexus, as you can see in the presentation. No physical presence is required. Again, you are purposefully directing business towards my state, regardless of whether you have a physical presence or not. And what happened, and again, picture my board, the states now were sitting up here. If I was in class and I had my T account up, I would take the line, I would draw a line from economic-based nexus that was developed for corporate structure, and I would draw a red line up to sales tax. The states witnessed the exception of economic-based nexus for corporate tax with no successful legal challenges. And they said, wait a minute, the states now were going to adopt economic-based nexus for sales tax. And again, economic nexus concepts for sales tax is the concept that specific number of sales. Again, a combination of 100 transactions, $100,000 worth of sales, or 200 transactions and $200,000 worth of sales. Now, in between this panel, it's not here in this panel, but October 1st of 2005, I want you to understand how this happened and why. October 1st of 2005, I served on the governing board of the Streamlined Sales Tax Project. And the concept between the Streamlined Sales Tax Project was this. The states collectively got together and said, listen, you're generating too much revenue through sales that we can't currently charge sales tax on, which was internet and catalog sales. And we have 24, a lot of people are not aware of this. We have 24 fully implementing states that are involved with the SSTP, the Streamlined Sales Tax Project. Now, it was supposed to be called the Simplified Sales Tax Project. But when we got there that day, we realized, the governing board, we realized there was nothing simplified about it. And we renamed it the Streamlined Sales Tax Project. And to be honest with you, it's just because all the paperwork, all our paper and business cards had been made up with that SSTP logo. There's no other reason why it was renamed. But one of the streamlined, there was a couple of things that made it streamlined. All sales will be sales tax to the state of destination. That's how the states were going to get their money. But Quill would actually, and again, we have 24 fully implementing states that are part of the SSTP. And I've got to tell you, one of the biggest pieces, one of the biggest concerns or confusion that came from that is, to simplify it, I'm going to explain it this way, I think. I'm a business, I'm residing in a particular state that is not involved with the SSTP. And we have states of origin in this country. But now I'm selling into one of the states that are part of the Streamlined Sales Tax Project, which by law now is a state of destination. Which state sales tax should I charge? I have had clients in the past that were charging sales tax to both the state of origin and the state of destination just to not get into trouble. But that's a whole other seminar, as Marty mentioned. But just so you're aware of it, the correct procedure here would be 1967 National Bellis Hess, 1992 the Quill Corp case, 2005 the Streamlined Sales Tax Project. I don't mention it in these presentations unless I'm doing a presentation just on it, because it is a voluntary system. It is not mandatory. But we have 3 distinct sales and use tax systems running simultaneously in this country. I'll say the traditional one, the SSTP, and now Wayfair. But I tell you about the SSTP because the Supreme Court justices, there was no de minimis amount of money attached to it. And they were afraid, rightfully so, that the increase in compliance would hurt the mom and pop shops. And they were correct. And so it never came into its full being. It's still a voluntary system. Why Wayfair was passed is the Supreme Court justices liked the de minimis aspect of it, $100,000 or $200,000, 100 transactions or 200 transactions. And so it was passed because they liked that de minimis amount of sales. And that's the only reason why something finally got passed through the United States Supreme Court. Of course, again, it kills Quill. All right, and we're going to go back to that because we're going to talk more about traditional Nexus as opposed to Wayfair, as opposed to corporate Nexus. I'm going to marry the three pieces together for you. All right, Lisa, can you advance it for me, please? Okay, again. Okay, thank you. Let's talk about 86-272 for a second. It was enacted in 1959. A lot of people are amazed at how long it's been around. It restricts the state from imposing an income tax when a seller's only business activity in the state are the solicitation of orders for tangible personal property. Okay. Examples: solicitation of orders by an in-state resident employee or representative of the company, so long as such person does not maintain or use any office or any other place of business in the state other than an in-home office that are not publicly attributed to the company. I tell you about this because in the past couple of months, I've seen clients that attend my seminars. Any seminar that's attended, and it's a niche seminar, doesn't have to be state and local taxes. Attendees usually come because they have specific issues that they want us to address and look at. And so they're bringing these notices. So I see all these notices. This last company that this happened to, their sales representative, without their knowledge, went and advertised the old-fashioned way, first of all, in the white pages, and then through the internet. And he what? You cannot use an office or other place of business in the state other than an in-home office. And he went and publicly attributed to himself. And the state came after him. And that company got into a lot of trouble. Lisa, can you advance it for a second? Thank you. I'm going to tell you more about 86-272. One of the biggest, what is protected under 86-272? And again, like Marty said, we're going to be doing other seminars. You can have a resident sales rep living in the state, solicitation of sales of tangible personal property, selling a widget. You would be afforded protection under that umbrella, as long as the sales rep does not do any repair work, does not do any warranty work, does not do any installation work. A lot of taxpayers are not aware of it, especially the installation work. I see a lot of notices because of that. They can absolutely train their workforce, but they cannot train their clients. And one of the other things too that's really, you know how somebody will say to you, hey, did you hear this about Joe? And then you hear it 3 times for 4 different people, like in the same week. That's kind of like state taxes. Like I'll hear nothing about, oh, what's creating Nexus or what are we having problems with now? And then all of a sudden I'll hear the same issue in like the past 2 or 3 months. And I know that's what the states are looking at. You can stay under that umbrella of protection as long as that sales rep does not have the authority to accept an order out in the field. The sales rep cannot have the authority to accept an order out in the field. that would kick you out of that Public Law 86-272 protection. For an example, if you were going to participate in a trade show and you had your booth, you can picture your booth set up and everything. I promise you this is the truth. They are called Nexus agents. Well, a Nexus agent's going to come up to your booth and absolutely say to you, not tell you that he's a Nexus agent, and absolutely say to you, say you were selling, I don't know, a pencil holder, and come up to you and you say to you, gee, I really like that color. That's my daughter's favorite color. And I like to buy it from you today because tomorrow's her birthday. You absolutely cannot, when you participate in a trade show, you absolutely cannot sell anything through that trade show that day through your booth. That will what? Trigger a filing requirement, not only for sales tax, but for corporate tax. And another thing, believe it or not, the state of New Jersey has what they call Nexus agents sitting along the New Jersey border. And they're looking at these panel trucks that are coming in with your business name on it. And they're looking to see where you're dropping off your product. And then 3 or 4 weeks later, they're going back and they're pulling these surprise sales tax audits to see if you're what? If you're correctly registered and collecting sales tax. For a fact, they're called Nexus agents. Lisa, can you advance it again for me? Thank you so much. Getting back to economic nexus. Many states have adopted a doing business standard for determining whether in-state activities create nexus for income tax purposes and have, again, specific activities not requiring a physical presence, such as transactions involving tangible property and services that fall out of the protection of 86-272. Some states have expressly adopted an economic presence standards for income tax purposes. Lisa? Okay. What I have done for you today is, and you can see where we updated it yesterday. I have given you charts that will show you economic nexus, which states follow economic nexus. And again, you'll see a chart which follows franchise tax nexus. Now, there's a couple of things I want to bring to your attention. And I'm going to turn away just for a second to look at my chart, which is a little bit bigger. And I wrote some things I want to bring to your attention. Really quickly, I want to tell you, I don't want you to think that, you know, we transcribe something incorrectly. Illinois says this: if you were to call the state of Illinois and ask them, could you please help me? Are you an economic nexus-based state? Or I have this particular situation going on with a new taxpayer, with a new client. Do I have a filing requirement? Illinois will not answer your question. They will ask you to do some type of a modified letter ruling. Again, the same thing with Vermont. Vermont will say to you this: if you have $1 of a positive apportionment factor, you would now have a filing requirement. Lisa, can you advance that? Because I see that I'm going to run out of time in a second. Again, I told you what factor-based present standards are. Okay, Lisa. Okay, and again, well, let's see, for 2021, they've had small increments for inflation. It is now $63,726 of property compensation paid, or $637,252 of sales. Lisa, let's go to the Wayfair page because I really want to spend some time with them on that. Okay. All right. And there's one more now, one more page. There we go. Okay. I want to give you an idea of what Wayfair is and how traditional Nexus is still alive and well. And we've modified this. I have a full chart, a full complement chart that I'd be happy to send you, happy to discuss with you in any way, shape, or form. Please let me know. But for instance, I wanted you to see this. See how Arizona says, if you have $100,000 of sales into my state, okay, you would now have a sales tax filing requirement because of Wayfair, okay? And you can go down the line and you can see New Jersey, New York, Rhode Island, Texas, and Vermont. And of course, we do have the full complement for you. What I don't want you to do, and what I want you to recognize, and what I'm seeing these notices and errors being made, is a lot of taxpayers, for the first time now, they're really catching on to Wayfair and the significance of it and what it means for their business. And so they're so focused on Wayfair, they forget about what I'm going to call traditional Nexus. So literally, let's look at Connecticut. You could say to me, well, Inez, I didn't trip Connecticut, okay? I don't have $100,000. And see how Connecticut is and or. You got to be careful with that. But Connecticut, you could say to me, well, Inez, I don't realize why I got this notice. I didn't trip Wayfair. I don't have $100,000 worth of sales into my state. And I certainly don't have 200 transactions into my state. So I don't feel as though I have a sales tax registration obligation. But they forget about their traditional Nexus. And it's kind of like, yeah, you didn't trip Wayfair, but guess what? You have a resident sales rep living in a state. A resident sales rep living in a state will always trigger a sales tax registration obligation. Or you have installation going on in that state. That's going to trigger both a sales tax registration and a corporate tax registration. Now, what if you come down to California? Well, we're not showing California, but what if you're coming down to a state that's factor-based Nexus standards? And you say, okay, I haven't tripped Wayfair. I don't have anything else going on in the state except for sales, okay? I have no resident employee. I'm not going into the state, much like my knife manufacturer. However, I have tripped this franchise tax-based Nexus standards now. I've got to remember that I owe California an $800 minimum tax. So now you've got to look at Wayfair, get comfortable with that, and you still have to look at traditional sales tax Nexus. And don't forget, you've got to, when I write a state and local tax analysis, I have to bring all the pieces together. It would be so negligent of me to just focus on sales tax and say, wait a minute, you've got sales into non-net income tax-based states. You should have been filing a corporate state tax filing. I apologize, a corporate state tax return. So you can no longer, I can't tell you in this past year how many notices that I've seen that people have asked me for help. And I'm so pleased that everybody's focused on Wayfair. Believe me, that they're getting it, but they're forgetting the other pieces about traditional Nexus. And that's not too good. So please keep that in mind. With that being said, let me see what I had here. Okay. Marty, are you going to ask me questions now or?
I will if you're done.
Okay.
Let me also tell everybody that we have these slides. We'll make them available afterwards. So some of these charts are we packed a lot of information in them, and frankly, they've changed a lot in the last couple of months. So we will make these slides available to you. And as Inez said, we're going to have additional SALT state and local tax webinars probably in March or April. Okay. We'll let you know when that is. So a few questions for you, Inez. Is it possible to have a corporate tax requirement but no sales tax requirement in the state, or vice versa?
Yes, it is, Marty. And again, I get asked this question all the time. go back and think about what I just told you at the beginning of the seminar, okay? You absolutely can have a sales tax filing obligation into the state and not have a corporate state tax filing obligation because you're protected under Public Law 86-272, okay? The other way around now, remember that umbrella. Sales tax is not a true net income tax based state. So you absolutely, and for that reason, we say Nexus for sales tax is much more sensitive. It's much more lower. It's not under Public Law 86-272. If you have created a corporate state tax filing requirement, now we have 5 states in this country, Alaska, Delaware, Montana, New Hampshire, and New York, that do not have a sales tax filing system whatsoever. So again, I'm not talking about those 5 states with no sales taxing system. But if you absolutely, you could have, if you have created a corporate state tax filing requirement, for a fact, you've created a sales tax filing obligation. Again, unless it's those 5 states that don't have a taxing system, all right? And we do, when we do a multi-state tax analysis for you, we look at all these pieces and we bring them together. And that's where I see a lot of, I'll call them holes. Like you knew you had a corporate state tax filing requirement, but you didn't think about sales tax, or vice versa for that matter. So we kind of, you've got to kind of always think about how do these 3 pieces fit together?
Got it. Thank you. You mentioned that a lot of these states' rules keep changing. Is it as easy as saying these states are looking for revenue and they just keep drumming up new ways for them to collect some more receipts?
Absolutely. And again, when I tell you something wicked this way comes, it certainly will. I've been doing nothing but multi-state taxes for well over 35 years. And I am telling you for a fact, 2022 will be the year for state tax audits. And especially the states will be focusing on what? A sales tax audit. So you've got to get ready for this. You need to really have, really sit down and look at your sales tax and your corporate state tax filing obligation and see if you shouldn't have a state and local tax analysis performed. And actually, you know, people forget there's such a thing out there called a reverse sales tax audit. And we do just the opposite. We look at your current filings and it's a reverse sales tax audit. And we tell you where you should be filing, or in this case, if you're charging sales tax correctly on what you're selling, that's a reverse sales tax audit. And the benefit to a reverse sales tax audit, I just did one about maybe 8 months ago, is that it saved the client. The client was incorrectly charging too much sales tax on one of the products it sells. It saved the client $28,000 right there because we amended some prior returns that we could, but prospectively now it's saving that client money. And then Marty, the one thing I also want to talk about, and I think you know this, is the questions I have on Wayfair, on like a registered remote seller. Okay. I kept on getting asked so many questions when I guest speak on what is the threshold? Let's talk about this for a second. I'm going to read you the question and then I'm going to tell you the answer. And I have to put my glasses on to do this. I am a registered remote seller in a state. This is through Wayfair. Now, this is all pertaining to Wayfair, these questions, and I'd be happy to send any of this to you. Mm-hmm. I am a registered remote seller in a state, and my sales have fallen below the threshold in that state. Okay. Do I need to stay registered? Again, I am a registered remote seller in a state, registered right away, got what Wayfair was and thought, boy, I better do this. Met the threshold. But now my sales have fallen below the threshold. Do I still need to stay registered? And it says, and I used $100,000 as an example. Although you may have exceeded the $100,000 threshold for sales in 2020 to require you to register, what should you do if your company is experiencing a decline in sales due to the coronavirus? Should you stay registered? And you need to examine the state's measurement period for economic nexus. Most states rule that a remote seller must register if they exceed the economic threshold in a previous or current calendar year. This means you have a 2-year period to examine your sales level. If your previous calendar year sales exceeded the threshold, but this year's sales have not exceeded the threshold, do not even consider or think about deregistering, for lack of a better way of telling it. How will deregistering and halting tax collections affect your clients? I would say give it at least another 2 years. And I'm going to do a couple of other questions pertaining to that. I was asked this question the other day by one of my long-term clients, and he felt as though his sales weren't going to maintain the threshold this year. And I said to him, you absolutely cannot even think about deregistering. Give it another year, if not 2. Mm-hmm. Because registering, deregistering, and then having to register again will clearly trigger an audit as sure as I'm sitting here. Mm-hmm. All right, the other question. I am a remote seller, and this is what I want to talk to you about. I am a remote seller and I exceed the threshold in a state, but all of my sales are exempt. You first need to know if the state's economic nexus threshold is based on gross, retail, or taxable sales. You may look at that chart. I have the full chart, believe me, and I update it every week, every other week myself. You may say to yourself, holy cow, I've triggered a sales tax registration filing obligation based on my sales into the state. And I would say this to you, yes, but look at that state. What is the definition of their threshold sales? And it's not uniformed throughout the country. Is it based on growth? Is the state saying to you, if you have $100,000 of gross sales, then you clearly have a registration obligation in my state now? Or is it saying to you, gross sales, retail sales, or taxable sales? You may think you have a registration filing obligation, but that $100,000 of sales you have into that state, and that state is only looking for taxable sales. And say 50% of your sales are taxable, 50,000 are taxable, and 50,000 are exempt because they're sales for resale. You would not have triggered that filing obligation because you're not meeting the definition of what constitutes a threshold. And that's what I really wanted to talk to you about at the end of this presentation. Do not get upset when you first realize I've crossed the threshold. You need to understand what is the definition of those threshold sales, because you may very well not have, okay? Example 2. A state you sell into only includes taxable sales for economic nexus determination, and the only product you sell into that state is exempt. In this situation, you do not need to register with the state, even if you exceed the threshold, because $100,000 of your sales are exempt, and they only want to know about your taxable sales. Example number 2, the product you sell into a state is exempt under state law, but this state uses gross sales to determine economic nexus for remote sellers. If you exceed the threshold in this example, you would be required to register, because gross threshold includes all types of sales, both taxable and exempt. Please note, since your product is exempt, you would be filing a 0 tax return. See the difference between that and the previous example? This one here is saying to you, gross sales. So you're meeting it, but you're going to be filing an exempt, gross sales includes exempt sales. That's what I'm trying to tell you.
Yeah.
You're meeting the threshold, but you'd only be filing 0 returns because all of your sales are exempt. And then the last example, your sales are exempt as sales for resale. If you exceed the threshold in a gross sales state with these sales, you need to register. Your sales are exempt as sales for resale. If you exceed the threshold in a gross sales state with these sales, you need to register again, but would only file 0 returns. I know this sounds very, very confusing, and I apologize. I would be happy to send you those answers, the questions in the answer paper that I did. I can tell you not to panic at first when you realize you have a filing requirement until you're absolutely sure as to what makes up those threshold sales. So please keep that in mind. What I do recommend is clearly if you have sales for resale or exempt sales, make sure that you're what? Collecting your exemption, the correct exemption certificates, because in any sales tax audit, and mark my words, 2022 is going to be the year of the sales tax audit. One of the first things the state asks you for is a copy of your exemption certificate folder. Well, make sure that's up to par, please. Lenny?
All right, Inez, I think we have a few more minutes. There's 2 more questions, looks like. One is you mentioned in New Jersey, I think, that there are Nexus police at the border and catching trucks coming in.
Yeah.
What are the other 2 or 3 key ways that states find taxpayers who aren't filing their income tax returns or sales tax returns in the States?
Oh, that's easy. For 35 years that I've been doing this, Marty, you want to stay the worst states in this country for multi-state taxes is California. Stay away. Very difficult to deal with. Texas, very difficult to deal with. Pennsylvania's gotten a little bit better, but they're difficult. New York is difficult. Connecticut now, I shouldn't say, it used to be Connecticut. Connecticut made up the 5th state, but Connecticut now has become much more user, or I should say taxpayer friendly. But stay away from California and Texas. You'll wish you were on the moon.
But how are they finding people that should be filing that aren't? What are they cross-referencing to?
Well, believe it or not, prior to all this even happening, I'll say like 3 or 4 years ago, when an audit, and this almost sounds illegal, when an auditor goes out into a field and does a sales tax audit, not only are they looking at, has this particular taxpayer been reporting sales tax correctly or charging sales tax correctly? They notice who your invoice, who the invoice is going to or coming from. And they actually started to create this database. So most sales tax audits happen because they found out who you were through auditing one of your clients for a fact.
Interesting. And last question. You see a lot of tax notices for both income tax Nexus and sales tax Nexus. Yeah. What would be the 2 biggest things that reasons that people are getting these notices in your opinion?
Corporate notices? Yeah.
Corporate income tax or sales tax notices related to Nexus. What would be the 2 biggest things that you see? Well,
from the corporate side, okay, people do not, and I say people, I mean taxpayers, do not recognize this whole concept of selling into a non-net income tax-based state. They don't get that was because they don't have a physical presence, Monty. They don't have a sales rep in there. They don't do installation. They don't get that just having sales into these non-net income tax-based states technically has created a sales tax filing obligation. The other thing I see for corporate next notices is many states in this country, if you were to visually look at their state tax return, you would see Schedule A, computation of net income, Schedule B, computation of net worth, franchise tax. whatever they're calling the non-net income tax piece of that return on the same return. And clients or taxpayers are filling out the income side piece of it. Okay, but they're forgetting about, geez, I owe again, it's the non-net income tax base issue. They're
Yep.
forgetting about filling out the net worth or whatever the state's calling it.
Well, thank you. We're going to bring this session to a close. Inez, thanks very much. You obviously have forgotten more about SALT than all of us on this attendees have ever known. It is a very complex scenario, and we recommend to anyone on this call that if they have questions, please contact at Stowe Degon or Inez directly. And
Absolutely.
And last thing is we will have another session on upcoming about SALT in the near future, in the next month or two.
Absolutely.
So with
Thank you
that,
so much.
thank you very much, everybody, for attending, and we'll see you at the next installment of our webinar series. Thank you. Have
Thanks,
a great day.
guys. I appreciate it.